Hey guys, welcome to my company analysis Lite platform. This is Medifast Stock Analysis. Let's jump right into it. You can see that the stock had a nice decline. We can't really see it here. But if we go over to Trading View, we can see it way better on this chart. So you can see that there was an incredible, I think it's like 75% decline. It's 70% decline, and now the stock is at 90. So let's see what we think of the stock. So first of all, the growth. To be honest, there's nothing wrong here. Amazing. In 8 years, went from 200 to 1,500 in revenue. Actually, just incredible numbers from 20 to 140, a 7x on the uh, net profit margin. That is incredible. And the profit margin basically, well, it increased a little bit. And for the free cash flow, same story here from 26 to 177, and then the profit margin here actually went from 9 to 11. So as you can see on the charts, really amazing growth from Medifast here. Okay, so profit margin. Unfortunately, it's actually they have the same profit margin as the industry average. That's interesting. Okay, not bad there, I guess. The P ratio is definitely lower at only 7, so pretty nice. The price of free cash flow is also very nice and is lower than ever, as you can see. It really was at this 20 to 10 area, and now it has dropped to 4.95. And the incredible level of ROIC here, 150%. Here in 2020, it was 800%. That is crazy. This company's ROIC is so good. I'm still blown. How is their ROIC that big? Anyway, so let's move on to the financial health. So the current assets, total current assets, are going up, not by too much. Of course, the total current liabilities are also going up. Uh, same with total long-term assets and total long-term liabilities. They're just all going up. Uh, for the shares outstanding, they're going down, just not by too much. And then the debt has actually gone from 0 to 26 million, so not that great. But they have more than enough cash and free cash flow to pay their debt whenever they want. Now, Medifast actually does pay a huge, well, no, it's pretty big 7% dividend, and their payout ratio is only 51%. The average growth rate is actually 34% over the last 5 years, so amazing there. As you can see, the dividend yield is growing, and the payout ratio is actually below 65%, which is what we like to see. Uh, so as you can see, the dividend yield is actually growing and the payout ratio is basically staying stable. What this means is that the company is growing in profits and then basically paying out the shareholders with that profit. Now let's go to the summary and valuation. So the 5-year revenue growth is insane. Uh, the margins decreased over a 5-year period by 20%. Same with the free cash flow margins, so not great there. And then their profit margin is the same as the sector average. That's such a coincidence. But I guess it's fine. And then the PE is actually smaller than the sector average. the 5-year price to free cash flow is less than 15. Is that, wait, what? It's actually more? So so the price actually went down significantly. It actually wasn't, it went down so much that the normal price to free cash flow is 21 and now it's at 4. Okay. Anyway, amazing ROIC, current assets and liabilities, nice, incredible long-term assets and liabilities, debt to free cash flow is less than 3. It's actually literally almost 0. And then the average share change is basically 0. Uh, so let's see. Uh, I will actually go ahead and basically estimate this company is not going to grow at all. For the profit margins, I want to go a little bit more conservative, uh, because the company actually has some problems. The reviews on the company are not that great from customers recently. Uh, and there's a lot of stuff that went wrong, but the management is doing their best. Right. I'll actually put in a really low P ratio, cause I don't want to overpay for this thing. And then I'll leave that as is. So as you can see, Medifast is kind of cheap. Of course, there are many problems. So the 5-year profit margin is going down. The profit margin is lower than the 5-year profit margin, which I don't like. Don't actually. Let's just check. This. So it's basically, it just went downhill from 2018. It's actually a bad year to compare it with, though, because really the profit margin has gone up from the start, right? It's not that bad. Yeah, I mean, this company is, I love the fundamentals of this company. It has no debt, it has a ton of assets. Uh, right? The PE is really low, and the growth is really there. Uh, you can see that we valued it at no growth, and it's still undervalued. So my take on this is, if you think that uh, the company isn't going to grow for the next 2 years, for the next 10 years, uh, then I think that the company is a buy. But I'm actually a little concerned because I think that it's the best case scenario for the company to just not grow. Actually, if we go to Trading View, go to earning estimates, yeah, you can see that definitely they expect a pullback on earnings, but I don't know if they can make it back. There definitely is some potential growth in it. Uh, so yeah, overall, it's just basically what you believe in. I believe that this is a pretty nice buy right now. Uh, but as I said, there's a lot of concern in the market, so I'm just going to wait for that 20% margin of safety also. So anyway, I hope you enjoyed this video, hope it was useful. If it was, then make sure to like and subscribe, and I hope you enjoyed it, and I'll see you next time.